How can we determine a country's performance? Is it based on a thriving economy or a faltering one? Politicians discuss it frequently. News outlets highlight it with red or green indicators. Central banks modify interest rates accordingly. At the center of these discussions lies one crucial figure: GDP. But what is GDP exactly? How is it calculated? What insights does it provide? And what does it omit? In this video, we will break down GDP step by step. So whether you're a student, curious, or seeking clarity on economic growth, this is for you. Welcome to Unravel: Money and Economics. In this channel, we simplify the world of finance, economics, and money so you can understand how it all works, no matter your background. GDP represents gross domestic product. It sounds complex, but the concept is straightforward. Visualize all that a country generates in a year. Every car manufactured, every coffee sold, each haircut given, every app downloaded. By totaling these in monetary terms, or in your local currency, you arrive at GDP. It signifies the overall market value of final goods and services created inside a country over a defined time frame. Typically, we evaluate GDP on an annual or quarterly basis. It's vital to focus on the term final. This indicates GDP accounts only for finished products, not every stage of production. For instance, if a factory produces tires sold to a car manufacturer, we don't tally the tires separately. We only assess the car's selling price, as the tire costs are incorporated already. This prevents double counting. Think of GDP as a scorecard for a country's economy. A higher number reflects greater production and exchange of goods and services. Now, why is GDP a focal point for so many? Because GDP serves as a clear indicator of economic health. Rising GDP usually indicates increased spending, investment by companies, and job creation. Politicians often emphasize GDP growth as a sign of advancement. Conversely, if GDP declines or merely slows, it may indicate difficulties. Reduced spending entails lower profits. Firms might halt hiring and could even lay off personnel. In severe situations, consecutive quarters of declining GDP can lead to a recession, impacting everything from stock markets to home prices. That's why central banks, such as the US Federal Reserve or the European Central Bank, closely monitor GDP trends to make decisions about interest rates. In essence, GDP provides a broad overview of the economy's growth, stability, or contraction. Let's delve deeper. You might often hear terms like nominal GDP and real GDP in reports. What sets them apart? Nominal GDP is calculated using current market prices. If inflation drives up prices, nominal GDP rises, even if actual production remains unchanged. This can be misleading. Economists, therefore, rely on real GDP, which factors out inflation. It reveals the genuine volume growth of the economy, not merely the pricing changes. For example, suppose last year your nation produced 100 units at $10. Thus, GDP equals $1,000. This year, the same 100 units now cost $12 each due to inflation, making nominal GDP $1,200. But has your economy genuinely grown? Not really. You've produced the same quantity. They've simply become pricier. Real GDP would rectify this, possibly indicating little to no growth. Consider nominal GDP as the raw figure, while real GDP serves as the inflation-adjusted data telling a clearer story. Next, let's clarify GDP versus GNP, gross domestic product, in contrast with gross national product. This is a subtle yet significant difference. GDP encompasses everything produced within a country's borders, regardless of ownership. GNP, however, accounts for everything produced by a nation's citizens or companies, irrespective of their global location. If a Japanese firm manufactures cars in the US, it contributes to US GDP because the cars are produced in the country, yet it counts toward Japan's GNP as the enterprise is Japanese. This distinction gains importance amid globalization, where businesses span multiple nations. You may wonder, how do economists compute GDP? The most prevalent method is called the expenditure approach, represented as follows: GDP equals C plus I plus G plus X minus M. Let's dissect that. C signifies consumption, representing all household spending on goods and services, groceries, rent, clothing, entertainment, etc. I denotes investment, Not in stocks or crypto, rather, investments in new homes, equipment purchases, or factory construction. These are long-term assets. G represents government spending, spending on infrastructure, education, defense, and public salaries, excluding transfer payments like pensions. X minus M stands for net exports, the value of exports minus imports. If imports exceed exports, this figure turns negative. Add these components together to derive the total GDP. And indeed, statistical agencies compile this data quarterly to refresh official GDP figures. Now, while GDP is a great economic metric, it has its drawbacks. GDP fails to indicate wealth distribution. A country might boast a high GDP, yet that doesn't guarantee widespread benefits. If 10 individuals generate 1 million in GDP, but one retains 900,000, are the other 9 truly thriving? Additionally, GDP overlooks environmental degradation, unpaid labor like caregiving, and overall happiness. This is why numerous economists now consider GDP per capita, GDP divided by population, as a more accurate measure of individual prosperity. Furthermore, newer indices such as the Human Development Index include factors like education and life expectancy, along with happiness reports. So while GDP is valuable, it doesn't paint the entire picture. Finally, let's conclude with a few real-world comparisons. Currently, the United States proudly holds the highest nominal GDP, surpassing 25 trillion. China closely follows, rapidly closing the gap. India, despite a lower total GDP, experiences one of the world's fastest-growing economies. However, if we analyze GDP per capita, the rankings shift. Countries such as Luxembourg, Norway, and Switzerland rank highest, not because they produce the most, but due to smaller, highly productive populations. It's akin to comparing a large restaurant serving 1,000 customers daily to a boutique gourmet spot serving just 50, yet at superior quality and price. Context is essential. So now you understand, GDP is the overarching number representing a nation's production. While it's not flawless, it influences policies, directs decisions, and facilitates comparisons of economies globally. What is your country nominal GDP, real GDP, and GDP per capita? In future videos, we'll explore inflation, interest rates, and government expenditure. Got a question or topic you'd like unraveled next? Leave a comment below, and don't forget to subscribe. As we continue to explore the world of money and economics, one concept at a time.